Hi, and welcome to Chapter 17, Hybrid and Derivative Securities. Our learning goals for this chapter include learning about the difference between hybrid and derivative securities, talking about different types of leases, lease agreements, lease versus purchase, operational leases, advantages and disadvantages of leases, financial leases. We're looking at different types of convertible securities. We're talking about how you value a straight bond versus a conversion bond, look at key characteristics of warrants, and talk about the role options play in hedging risks for companies and different trading options of the options market. First, let's start with what is a hybrid security. So a hybrid security is just like you'd expect it. It's a piece of two different things. So it's a piece of debt, it's a piece of equity. So they possess the characteristics, some characteristics from both debt and equity. Now, examples of these include preferred stock, financial leases, convertible securities, and stock warrants. A derivative security is a security where the value of the security is derived from another security. So, derivative security is more like a contract where the underlying value of the contract is based on another security. And we call this arena derivatives. Okay, so let's first start with leasing. Most people are familiar with leases because of the popularity of automobile leases that many people that you may have or people you know may have engaged in such a lease. And it's a way of getting an asset typically at a lower cost for a limited period of time. So it's sort of like renting an asset. So it's a process by which a firm can obtain the use of an asset, but must sign a contract and make periodic tax-deductible payments. So the leasee is the receiver of the asset or the services under the contract, and the leaseor is the owner of the asset who is leasing it out to somebody else. So think of a lease as you have a landlord of the lease and a renter of the lease. So the renter of the lease is a rentee, and the landlord of the lease is a rentor. So there are two different type of classifications for leases. There are operating leases and financial, or sometimes known as capital leases. So an operating lease is a lease that can be canceled. The leasee agrees to make periodic payments to the leaser, often for 5 or fewer years, to obtain the services of the asset. Generally, the total payments of the term of the lease are less than the initial cost of the leased asset. And that would be why they would want a lease, is because you want to pay less than the cost of the total asset. Now, a financial, or more commonly called a capital lease, is a longer term lease and generally more than 5 years, longer than an operating lease. It's something that you can't cancel, and obligations of the lease to make these payments for an asset over a predefined period of time. The total payments over the term of the lease are greater than the leaser's initial cost of the leased asset. So you might want to say right now, like, well, why would anybody do a financial lease if you're paying more for the asset than if you could buy it outright? Like, why does that make sense? We'll get to that in a minute. So now, a lot of this has to do with companies in leasing. There are tax ramifications for leasing. So, and the way you record the account for the lease is under a FASB ruling. So FASB is a Financial Accounting Standards Board, and they release statement number 13, accounting for a lease. A financial or capital lease is defined as one that has the following elements. So if you want to have your lease be defined as a financial lease, it must, one, the lease transfers ownership of the property to the leasee at the end of the lease term. So that means that at the end of the term, the leasee will own the property. The lease contains an option to purchase the property at a bargain price. Such an option must be exercised at a fair market value. The lease is equal to 75% or more of the estimated economic life of the property. And at the beginning of the lease, the present value of the lease payments is equal to 90% or more of the fair market value of the leased property. Okay, so let's look at a popular area of leasing is leasing airplanes. to airline carriers. So, using this lease structure is a way for a cash-rich company like Disney to purchase airplanes and lease them back to airline carriers who are typically cash poor. So under this, leveraged lease, Disney is a company that put down 20% of the purchase price for the planes and borrowed the rest under a loan using the planes as collateral. So during the 90s, these leveraged leases were attractive investments. However, after the effects of 9/11 on air travel, which reduced air travel or the amount of people traveling, the carriers had a lot of financial stress. There was also depressed economic state at that period, so less people were traveling. So Disney had to write off nearly $114 million of book value assigned to this investment in two Boeing 747s and two 737 leases to United and $68 million for leases to Delta. So, what had happened is they made these leases to these airline carriers. The airline carriers, if they go into bankruptcy, have certain abilities to get out of leases, leaving Disney with losses for these planes. So at this point, Disney got out of the leasing business because it was no longer, they saw the risks involved of it when you deal with airline carriers. Now let's talk about the lease arrangements. A direct lease is a lease under which the owner, the leaser, owns or the asset that's going to be leased to the leasee. All right. A sale leaseback agreement under which the leasee sells the asset to the lessor, then the leasee leases that same asset, making fixed periodic payments for the use. So a famous one of these is, in Chicago, there's the Sears Tower. So the Sears Tower was owned by Sears, but then when Sears needed money, they sold the Sears Tower to another company and then leased back their office space. So it's a way for a big company to generate a lot of cash and then substitute by selling an asset and then, paying a monthly payment, which is far less than if they say they had a mortgage on the property. Or so typically the lease payments will be less than the cost of owning the asset with a loan, but this way they'll be able to liberate some capital in the process. So this is common for a lot of companies that want to, they may want to reduce their real estate holdings or their asset holdings, and that's why a lot of airline companies now don't actually own the planes they fly. They lease them. If they did own them, they did that at one point when they owned the planes. They did have a potential to do a sale lease back to another company to raise cash, and also it's just a different financial structure. Now, a leveraged lease is a lease under which the lessor, the owner of the asset, acts as the equity participant. So they supply about 20% of the cost of the asset while the lender supplies the balance. So this would be something like Disney does if you want to be, say you wanted to buy an apartment building, you could buy an apartment building, or maybe that would be for more of a personal example where you put 20% down, borrow the rest on the mortgage, and then then lease out the units. Or same thing if you wanted to buy, say, a shopping plaza, you could put 20% down and then borrow the rest and lease out the individual shops, in creating a leveraged lease where you borrowed money to obtain the asset and then you're leasing it out. Now, a maintenance clause. So this is, normally included in operating leases, and that requires the lessor, think of the lessor as the landlord, to maintain the asset and to make insurance and tax payments. So in the maintenance clause, the person who owns the asset takes care of making sure that the asset is up to date and fixed and working well and pays all insurance and tax payments on the asset. Now, a renewal option, just like it sounds, it gives a provision for in the operating lease that grants the lessee the right to release the asset after the expiration. So this is a way that, say you're an airline carrier and you depend on these planes and you're making plans to use these planes and the leases are going to be up next year, it gives you ability to continue operations and release those planes if you want to. And a purchase option is a provision included both in operating and financial leases that allow you to purchase the leased asset at maturity. And this is, you're familiar with this if you have an automobile lease, you at the end of the term of the lease, you have the option to buy the automobile at a discounted price. So a big decision to be made is, and you think about this, you may have done this already for a car, the lease versus purchase decision. Is it better to buy the asset or lease the asset? And there's a lot of factors that go into, you know, uh, if you have to go out and borrow the money yourself, and if you're in a risky position, you may have to pay a high interest rate for that money. It might be cheaper to lease it rather than raise your own money, or maybe you have cash that you want to spend on an investment, so it makes more financial sense to save the cash for investment and get a lease. These are different things to think about. So if you are going to do a lease versus purchase decision, there's a process you can go through. Now, this decision involves the application of the capital budgeting methods that we reviewed in Chapter 10, 11, and 12. And this is going to help us determine the relevant cash flows and apply the present value techniques in following the steps involved in this analysis. And it's one of the reasons that I reviewed Chapter 10 and 11 for this course, because a lot of the elements of those chapters are used in other chapters. So, step one. We want to find the after-tax cash outflows for each year under the lease alternative. So that, in this step, we generally are going to look at the tax simple adjustment of the annual lease payments, in addition to the cost of exercising the purchase option in the final year of the lease term. Should be included. Now, in step two, we find the after-tax cash flow of each year under the purchase alternative. So then we're going to look, in step two, we're going to look to buying it. Now, what's going to be the cash outflow for buying it? And then it goes adjusting for the sum of the scheduled loan payments, maintenance cost outlay for tax, or benefits for tax shields, such as depreciation. So we're going to be accounting for maintenance, depreciation, and interest. As we're assuming that if we purchase the asset, we're taking a loan to purchase. So step three, calculate the present value outflows associated with leasing, step one, and with purchasing, step two. So we can see alternatives. We want to use the after-tax cost of debt at the discount rate. So the company's discount rate could be the cost of capital. And then the after-tax cost of debt is used to evaluate the lease versus purchase decision. Because the decision is going to involve between two financing techniques, leasing and borrowing, that have very low risk. Now, step four, the alternative with the lowest present value of the cash outflows in step three will be the least cost financing alternative. And then you'll have your decision. So let's go through an example. So Robert's company, a small machine shop, is think about acquiring a new machine that costs $24,000. And arrangements can be made to lease this machine or purchase the machine. And we're going to assume that the company has a 40% tax bracket. So the firm would obtain a 5-year lease requiring annual end-of-the-year lease payments of $6,000. And we usually, for these problems, we're going to do end-of-the-year payments rather than monthly because it's easier to calculate. All maintenance costs would be paid by the leaser, and the insurance and other costs would be paid by the leasee. So the leasee would exercise its option to purchase the machine for $1,200 at termination of this 5-year lease. Now, if they were going to purchase it, they could finance the purchase of this machine with a 9% 5-year loan, requiring end-of-the-year installment payments of $6,170. The machine would be depreciated using the modified accelerated cost recovery schedule, using a 5-year recovery period. The firm would pay $1,500 per year for a service contract that covers all maintenance costs. Insurance and other costs will be borne by the firm. So the firm plans to keep the machine and use it beyond its 5-year period. So, step one. Let's look at the lease payments, and we can be found by multiplying the before tax payment of $6,000 by 1 minus the tax rate. So we find that after we take our tax deduction, the annual cost would be $3,600. So therefore, on this lease alternative, the outflow for each year for 5 years will be $3,600, and the final payment at the end of the 5th year will be $1,200. So if we look at, if we're going to calculate this up, we would want to get the total cash outflow in year 5 would be $4,800 when you added the 3,600 to 1,200 to the 3,600. Okay. Now, if we were moving on to step 2, calculate the after-tax flow. We're going to begin by calculating the interest portion of each payment, as only interest is deductible for taxes on the purchase decision. So we know our loan payment here, and we have our principal at the beginning of the year. So as we are paying our loan payment, it's reducing our principals after we account for interest. And interest is 9% of the principal. And then the principal, so if we're paying $61.70 minus the interest, this is the principal reduction that gets applied and reduces for the following year. So this is the end of the year principal based on the reduction of the principal, and that gets moved into the beginning of the year principal. Okay, so calculate the cash outflows associated with borrowing to purchase the new machine. So we have our loan payment, our maintenance costs, our depreciation, our interest. So for total deductions, we add 2, 3, and 4 together. 2, 3, 4 together to get 5. These are total deductions. Figure out our tax shield by multiplying our total deductions by 40%. This is our tax shield, meaning that these are deductions, but it's only going to shield us for 40% of our income. So that's why this is the tax shield. So the after-tax cash flows would be we have to take 1 plus 2 minus 6 would equal 7. So the loan payment plus the maintenance cost minus the deduction of the tax shield gives us our cash, after-tax cash outflow. So step 3, calculate the present value of the cash outflows associated with the lease and purchase alternative. So here we have the leasing after-tax cash outflow, so we know it's $3,600 per year. Last year has an extra $1,200 for the purchase. So we just discount all of these at the cost of capital, which is discussed earlier. If we go back in the problem, they give us the cost of capital here at 9%. That's what we'd use for the comparison. Okay. Now, the purchase, we have our after-tax cash flows that we calculated here. Going to move those up over here, and then find the discounted value of these after-tax cash outflows, and then find the present value of the leasing and the present value of the cash flows of the purchasing. And we see that the purchasing here is more than the leasing, so the purchasing is more expensive. So because the present value of the lease is lower than the purchase by $3,479, we should go with the least costly alternative of leasing. So that's a simplistic lease versus purchase decision. Okay, so let's go back and we'll look at a personal example of leasing. So Jake is considering leasing a new Honda Fit that costs $15,000 or a 3-year lease requiring $1,800 down and a monthly payment of $300. Purchasing requires a $2,500 down payment, sales tax of 5%, and 36 monthly payments of $392. So he estimates the trade-in value of the car will be $8,000 at the end of year 3. So assuming he can earn a 4% annual interest on the savings or investments subject to 5% sales tax on the purchase, we can make a reasonable recommendations for Jake using the following analysis. And we're going to be ignoring time value of money for this particular analysis. Okay, so lease, down payment, total lease payments, opportunity cost, loss of interest, and total lease cost is $1,200,516. If it was to purchase, down payment, sales tax, total loan payments, opportunity cost of this down payment, and then the trade-in value. So you'll see that the cost of purchasing is less than the leasing. So in this case, he should purchase. Now, a couple of things to think about. This $8,000 is you have to hope that the car stays in good condition. But even with the lease, you have to return the car in good condition. Otherwise, there are extra charges. So that part we're just not factoring in. Okay. So let's look at the effects of leasing on future financing. So capital lease, which is the financial lease, that has the present value of all its payments included as an asset and corresponding liability in the firm's balance sheet. So these capital leases are on the balance sheet as required by FASB Statement 13. An operating lease, on the other hand, does not need to be capitalized. And because its basic features must be disclosed in the footnote in the financial statement, establishes the details and guidelines for the capitalizing of leases. So operating leases, they're not going to be dollar-wise in the balance sheet, but they will be disclosed in the financial statements of having the operating leases. So let's look at this example. Jeffrey Company, a manufacturer of water purifiers, is leasing an asset under a 10-year lease agreement. This 10-year lease requires annual end-of-the-year payments of $15,000. The lease can be capitalized merely by calculating the present value of his lease payments over the life of the lease. However, the rate at which the payments should be discounted is difficult to determine. If 10% were used, the present or capitalized value of the lease would be $92,000. This value would be shown as an asset and corresponding liability in the firm's balance sheet, which should result in an accurate reflection of the firm's true financial position. So with financial lease, we're going to, we want to state that on the balance sheet in both the asset and the liability section. But we're going to have to, reflect it accurately, and that's why we would use time value of money. Okay, so in this particular slide, we're going to look at the advantages and disadvantages of leasing. So let me make this a little bit bigger. Okay, now keep in mind this is an area where there could be a lot of test questions on, especially true and false and multiple choice. So it's important to understand the advantages and disadvantages. So if we're looking at the advantages here, and then so the advantages can help us avoid the cost of obsolescence. So obsolescence is when something is just old, no longer useful, and has to be discarded. So so just think of it when you're leasing cars, you never have to worry about selling or getting rid of an old car that doesn't work anymore because you're constantly getting a new car. That's what they basically mean here. A lease avoids many of the restrictive covenants such as minimum liquidity, subsequent borrowing, and cash dividend payments rules normally associated with taking a long-term loan. So long-term loans can come with these covenants about what you can and can't do. Leases will remove those controls on your company. In the case of low-cost assets that are frequently acquired, leasing, especially operating leases, may provide the firm with additional financial flexibility. So instead of putting a lot of money up front or getting involved in a lot of loans, it's relatively easy to get these leases and gives you another alternative to acquiring assets without tapping into your capital budget pool of money. Leases allow the leasee in effect to depreciate. So at least to depreciate land, which would be prohibited if the land were purchased. So because the leasee who leases land is not permitted to deduct total lease payments as an expense, for tax purposes, the effect is the same as if the firm had purchased the land and had depreciated it. So it helps to lower the tax exposure. Now, because leasing may not increase assets or liabilities on the balance sheet, depending if it's a capital or financial lease, leasing may result in sort of misleading the financial aspects of a company. Hold on a second. Okay, so that's resizing this. So that could be a benefit if you don't want your financial ratios, your debt ratios to deteriorate and your assets to liability ratios deteriorate. Financial leases can hide, operating leases can hide some of the effects of what you would normally see if you had to borrow that money. But this advantage only applies to operational because financial leases are documented in the balance sheet. Leasing provides 100% financing, so most lease agreements will be for 100% of the assets. You often don't have to put any money down or much money down, but that's not always the case. And in case of bankruptcy or reorganization, the maximum claim of leasers against the corporation is 3 years of the lease payments. So it also limits the ability for these companies to have claims on assets if you go into bankruptcy. And that's one of the problems that when we discussed Disney's leasing of planes to Delta and United. They went to bankruptcy, so Disney was on the hook for a lot of the cost of the asset because of these pro-leasing bankruptcy laws in favor of the leasee. Now, disadvantages: in many leases, the return to the leaser is quite high. So basically, the leaser is making, generally, if everything goes right, and a company does go into bankruptcy, the leaser is going to make more money off of this transaction. That's why, these auto leases, generally, it's better to purchase than to lease an automobile, because the leases are in the favor of the automobile companies, just like the leases are in the favor of the person, the leaser. And when you lease an automobile, you're the leasee. The car dealership is the leaser. Now, the determining value of the asset, if any, is realized by the leaser. So generally, the leaser can sell the asset. So if the lease has been purchased, if the leasee had purchased the asset, it could have been claimed. It could have claimed the terminal value. So that's an additional factor. Who gets to claim the terminal value? Usually the leaser. The leasee, and that's important for taxes. The leasee is generally prohibited from making improvements. So that's a disadvantage. So if you're just like if you're renting, you can't go ahead and put in a new kitchen or upgrade the bathroom. You have to get permission from the landlord. In many cases, the leasee is the landlord, and you have to get permission from them before you make any changes or improvements on the properties or assets. And if the leasee leases an asset that subsequently becomes obsolete, you still must make the leasee payments in the remaining term of the lease, even though the asset is unusable. So maybe you bought some piece of technology that's been outdated, but you're still paying the lease on it. You still have to honor the lease agreement even though the asset's not usable. So those would be the disadvantages. Okay. So let's move on to convertible securities. Now, convertible security, think of like a convertible car or convertible couch bed. It's something that has the ability to change form. So conversion feature gives the company an option or investor an option to allow part of a bond or preferred stock to change the security into a stated number of common stock. So this gives the ability for preferred stock or bonds to be converted into common stock, which is a very powerful ability to have, and it enhances the marketability of these conversion products, which means it makes it cheaper for the company to issue these products. Now, a conversion bond, and this is something that was quite popular with Amazon, issued a lot of conversion bonds into stock. And since Amazon had a lot of future potential for its stock, the convertible bonds were discounted quite a bit. So a convertible bond can be converted into a specific number of shares of stock. A straight bond is a bond that is not convertible and has no conversion feature. So those are how we would state the two different bonds. Because the conversion feature gives the person buying the bond the ability to convert and become a shareholder, convertible bonds are generally less expensive for the company to issue than straight bonds. Now, convertible preferred stock is preferred stock this is something we went over in chapter 6 or 7, that can be changed into a specific number of common stock. Now, straight preferred stock is just preferred stock that is not convertible. So you see how the nomenclature of how we talk about these things. Now, so convertible market activity in 2013, we look at, it was historically low interest environment. Relatively few companies were raising debt via convertible bonds in 2012. Most companies elected to refinance outstanding debts, so more convertibles were retired than issued. Going into 2013, however, the bond spreads were tight and portions of the corporate bond market were oversold, making convertibles more attractive. In the first quarter of 2013, firms issued more than $25 billion in convertible securities globally, which is more than double 2012. So you can see that these convertible markets change with the environment and the economy and interest rates. So sometimes the convertible markets are more active than others. Now, the conversion ratio, that's the ratio at which the convertible security can be exchanged for common stock. And this is very important. Some conversion bonds and preferred stock, some of the ratios are better or more attractive, some of the ratios are less attractive, and that's going to determine the price of the underlying asset. So the conversion ratio can be stated in two ways. Sometimes you can convert in terms of number of shares of common stock. So to find the conversion price, what we do is it's the per share price that is effectively paid for each common stock as a result of the conversion of the convertible security. So divide the par value of the convertible security by the conversion ratio to figure out this conversion price. Two, sometimes instead of giving conversion ratio, the conversion price is just given. So the conversion ratio can be obtained by dividing the par value by the conversion price. So either method, the conversion price is sometimes simpler. You just know the price at which you can buy the common stock at. Or the conversion ratio sometimes can be an advantage if the price of the asset goes up. You can get more shares of stock. So let's look at these examples here. Western Wear Company, a manufacturer of denim products, has an outstanding bond that has a $1,000 par value and can be converted into 25 shares of common stock. So the conversion ratio is 25. And if we take the $1,000 divided by 25, we get the conversion price of $4 per share. So another company, a franchisor of seafood restaurants, has outstanding convertibles, a 20-year bond with a par value of $1,000. So the bond is convertible at $50 per share of common stock, so the conversion ratio here would be 20. Now, the conversion or stock value is the value which the convertible security measured in terms of the market price of the common stock can be converted. So if you have an outstanding $1,000 bond that's convertible into common stock at $62.50 per share, the conversion ratio therefore would be the $1,000 divided by the 62.5. Now, because the current market stock price has moved up to $65 per share, the conversion value is now would be now 1,040, or 16 shares of stock times 65. So because the conversion value is above the bond value of $1,000, the conversion is a profitable option for the owner of the convertible securities. So what you want, if you buy these convertible securities, generally the stock price is lower than the conversion price, and over time, as the stock improves in value, the bonds become more valuable as the stock price goes up. And if the stock price doesn't go up, you can still keep it as a bond and get your $1,000 back at the end of the term of the bond. Now let's talk about the contingent securities. So these include convertibles, warrants, and stock options, and their effects of reporting on earnings per share. So when you have these convertible securities out there, preferred stock and bonds that can convert to stock, that's going to increase the amount of outstanding shares. So when a company reports its earnings, it will report the basic earnings per share, which is the earnings as far as all the shares currently outstanding, not counting any contingency shares, and then diluted earnings per share, which would basically say, what if all those preferred and convertible bonds were converted to stock? What would the earnings per share look like then if they were all converted? So you get the basic and the diluted to give shareholders a better idea of what type of future potential stock of outstanding shares will be and their effect on the earnings per share. So convertibles can be used for a variety of reasons. It can be for a form of deferred common stock financing, a sweetener for financing to make lending bonds cheaper, issuing bonds cheaper, and a way to raise funds temporarily. So convertibles it's just another tool in the box of raising capital. Now, so when the price of the firm's common stock rises above its conversion price, the market price of the convertible security will normally rise in value close to the conversion value. So if you have a bond that's a $1,000 bond, and the stock price went up greatly, And if you did the conversion, you'd see the stock is equal that the stock tied to the bond is equal to $1,600. Then the bond is going to have to trade close to that $600 to recognize that value. So when this happens, many convertible holders, they may not convert or will not convert because they already have the market value baked into the bond or the preferred stock, and you can still receive that interest. So not only do you have the value of this inflated stock price, but you're still receiving interest. So why convert? So because of this behavior, it's virtually all convertible securities have a call feature, which enables the issuer to encourage a forced conversion. So if there's a point where the issuer doesn't need the money anymore and they have the money to pay back the bonds, they can force the conversion. And the call price of the security generally exceeds the stock's par value by the amount equal to 1 year stated interest on the security. So sometimes the company will do the math and say, okay, you know, what's better for us to do, the call, pay the 1 year's worth of interest, or to let them keep accumulating value as the stock price goes up. An overhanging issue is a convertible security that cannot be forced to conversion by using a call feature. So some bonds may have this overhanging issue. So let's talk about the straight bond. So the price at which a convertible bond would sell in the market without its conversion feature. So here we want to know what's just the value of the bond component without the conversion. So the value is found by determining the value of the non-convertible bond with similar payments issued by the firm with the same risk. So we compare them to similar bonds of the same risk. And the straight bond value is typically the floor minimum price at which the convertible bond could be traded. So the straight bond value is the present value of all of the bond's interest and principal payments discounted at the interest rate of the firm would have to pay on the non-convertible securities. So if we look back to the chapter on bonds, we could use that same methodology for valuing, determining the value of a straight bond or a bond without a conversion feature. Okay, at this point, I'm going to pause the video, and this will be part 1 of this chapter 17, and stay tuned for part 2 of this chapter.